This is Al Brooks. Thank you for watching the Brooks Trading course. This is a bonus video on how to trade the final hour. I want to begin by talking about how smart money, theoretically at least, trades heavily in the final hour. So the final hour has a greater influence on what will take place tomorrow. If there's a tight trading range after 12:45 Pacific time, usually it's better not to trade because the market will probably stay mostly sideways into the close. Next, I want to talk about a buy the close bull trend, and then a sell the close bear trend occurring in the final hour. Next, after that, I want to talk about magnets that are important in the final hour. The most important is the open of the day, and then the high and low of today, and the high and low of yesterday. And finally, I want to talk about how to exit positions that you take in the final hour. I want to begin with talking a little bit about smart money. Smart money, institutional investors, they pay a lot of attention to trading in the final hour because they have an entire day of information and they feel like the probabilities are somewhat better in terms of deciding what will happen tomorrow. Here is a series of days. This is the end of a day. That's the end of a day, start of another day. And there are 7 days here. And this is volume. And what do you notice about the volume? That heavy volume at the end of the day represents institutional trading. And they're trading for any reason. They might be hedging positions, they may be closing positions, they may be starting positions. You just don't know. But what you do know is there is very heavy trading toward the end of the day in the final hour, especially right before the close. And therefore, there is the potential to make money. If there's a lot of interest, a lot of trading being done by the institutions, there's an opportunity for a move at the end of the day. The general theory is that the majority of traders are emotional and they pay a lot of attention to news and they tend to overreact in the first 30 minutes. But smart investors trade much more intensely in the final hour after seeing what the day has been doing. As I said, you can look at the big volume spikes that occur right before the close. The close is 1 p.m. California time, Pacific time. Because the institutions are trading heavily, you often get reliable patterns. But the moves are often very quick and the stops have to be far because the bars can be big. So you have to be extra careful. On a 5-minute E-mini chart, there are 81 bars in the day. Bar 78 is the 1 p.m. bar. There are 3 bars that follow. Here's a daily chart in a bull trend. And what do you notice? Well, it's obviously a bull trend. Most of the days are bull days. That means they close above the open. And a lot of them are closing near their high. And if you look at a 5-minute chart at a couple of these days, what do you notice? The days are closing high. And also the final 8 or 10 bars rally. That means that there's an opportunity to make money at the end of the day. If the market's in a bull trend, most of the days will have bull bodies. They'll close above the open, and therefore you should look for a possible rally into the close. At the end of the day, look for a bull bar closing on its high, a breakout of a bull flag or a reversal, and buy above that bull bar and try to hold until the trend ends or until the day ends. Bear trend, just the opposite. Most of the bars on the daily chart are bear bars, and a lot of them close near their lows. A lot of these days are not bear bars until the final hour or so, and then you get a sell-off into the close. And therefore, you should be looking on the 5-minute chart for a sell-off at the end of the day. If you see a bear bar closing near its low, especially a second sell signal like this, a double top, you sell below the bear bar closing near its low, trying to capture several bars of selling at the end of the day. You exit either at the end of the day or on a late reversal up, like a bull bar closing near its high, you get out above the bull bar. It looks pretty easy. You got a bunch of bear bars closing near their lows at the end of the day. You got very big volume, 55,000 contracts on that bar, another 55,000 on that bar. But there are some important problems that take place at the end of the day that can make trading difficult. For example, here, you're in a bear trend. The market went up and went down. But what you don't realize when you look at this chart is how fast it went up and down. You have 3 bars closing near their lows, a reasonable sell the close trend. You sell the close or you sell on a stop below the low of the bar. If you take this sell below the low of this bar, your stop is above here or above there, so your stop is far above. If you used a tight stop, you would have been stopped out, yet the market would have continued lower. At the end of the day, you tend to be tired. You're physically tired. You're mentally tired. You don't think as clearly. You don't react as quickly, and you're more likely to make mistakes. You can make mental mistakes, judgmental mistakes, and you can also make physical mistakes. When you're clicking on orders, you can make a mistake. The bars are bigger, so the risk is bigger. The stop is further away, and the reversals can be very quick. And therefore, you don't have time to process information. For example, look at this 5-minute bar and look at the 5-minute bar that followed it. This bar was a big bull bar until the final 15 seconds and it sold off. And not only did it sell off, but that sell-off continued down to here, all in the course of less than a minute. And therefore, very little time to make a decision. Very common at the end of the day for a bar to be a bull bar and then become a doji or a bear bar in the final seconds of the bar, or to be a bear bar and then reverse up and become a bull bar. It makes it difficult to anticipate where the high or low of the bar will be, and it does not give you much time to place your orders. So order placement can be difficult. Here, although you cannot tell on this 5-minute chart, the market fell 8 points from this high to that low in 45 seconds. This is a chart where every bar is 15 seconds. This blue box is this blue box. So from here to there, it took 45 seconds to go from that high to this low, 8 points. And there were multiple reversals in this final pair of bars. We went down, we went up, we went down, and then we stalled. My point is that at 1 o'clock, you can get a very big move. Looks easy on the 5-minute chart, but it's not, because you don't have much time. And you should not be trading a 15-second chart, each bar 15 seconds. I guarantee you will lose money. So the bars are bigger, the moves are faster, you have less time to make decisions. Here we are late in the day, and we're starting to get bars that go sideways, bars with prominent tails, and we're reversing every bar or two. That is not a good environment for stop entries. You might think, okay, head and shoulders bottom, left shoulder, head, and right shoulder. And now we have a good bull bar closing on its high. Maybe you can buy on a stop above the high of that bull bar. But look to the left. The past several hours have been reversing every few hours. And here you are at the end of the day betting that this is going to convert into a bull trend. That's a low probability bet. You're taking a trade with low probability, not much time left in the day, so there's not much reward. So the risk is big, stop is down here. The reward is small because you do not have much time. And the probability is low because you're buying in the top half of a trading range. So that's a terrible entry for a stop entry trader. If it's bad for a stop entry trader, it's probably good for a limit order trader doing the opposite. So instead of buying above that bar, you probably have a better chance of making money selling above that bar. Because if it's bad for a stop order trader, theoretically, the institution taking the other side of your trade is a limit order trader. You're buying with a stop up here, he's selling with a limit order up here. And the math is better for limit order traders when the market's in a tight trading range, especially when there's not much time left for a big reward. If this was earlier in the day, you can take a low probability trade because you can make so much money on the reward side that you offset the low probability. You do not have that advantage late in the day. If a trader were to buy this head and shoulders bottom, hoping that the trading range would become a bull trend, he'd buy on a stop above that bull bar, and he'd put a protective stop below this low. But the math is bad. In this particular case, you can see there were clearly more sellers than buyers above that bar, and you would have been immediately stopped out for a big loss. That's the biggest bar that we've had all day, and here you are buying on the top of it, and you're getting stopped out below that low. So not a good trade. And if the market is sideways into the close, you don't want to be buying with a stop near the top, especially above a big bull bar. Even if a big bull bar looks good, and even if you can argue it's a buy setup, you cannot get enough reward. Buying a head and shoulders bottom is a swing trade. There's not enough time left for a swing, and therefore you cannot capture enough reward to offset the bad probability. Do not buy, wait for tomorrow. You could also, as an alternative, trade a smaller time frame chart, like a 1 minute chart, and then the bars will be smaller. You might be able to buy down here. Your risk is less. However, you will lose money if you're trading the 1 minute chart at the end of the day because everything happens very quickly. You will not have enough time to make decisions and to place your orders. You will make too many mistakes and you'll lose money. You may not lose as much as you would on this trade, but if you do it often enough, all the little losses add up into a big loss. So do not trade the 1 minute chart, especially in the final hour, and do not buy with stops in the top of a trading range, and do not sell with stops at the bottom of a trading range. This is a limit order market. You should be only trading with stops, especially in the final hour, and therefore you do not trade when the market looks like this. Sometimes you get a good trend, but then the market just gets very quiet at 12:45 California time, Pacific time. So for example, if we're trending up like this, pretty good breakout, but then we're getting 4 or 5 sideways bars, smaller bodies, more prominent tails, that's a tight trading range. That is also a bad environment for stop order traders. You can argue, well, it's a bull flag, we'll go higher. If the market is in a tight trading range at 12:45, right here, this is 12:45, if it's been sideways for 4 or 5 bars or more, it's better to wait for tomorrow because it's probably going to stay sideways for the rest of the day. Sideways at 12:45, small bodies, overlapping bars, prominent tails, tight trading range, not good for stop orders. Wait for tomorrow because you're probably not going to get a big move. And even if you were to win 60% of the time, your reward on average will be less than your risk. In other words, your losses will be bigger than your wins and you'll end up losing money. This is what you're looking for. You're looking for a trend at the end of the day, either a buy the close bull trend or a sell the close bear trend. Here we have a trend from the very first bar of the day, and it trended up all day. You got a good breakout here. Bulls will buy closes. This is a buy the close bull trend. When you get 1 or 2 or 3 bull bars closing on their highs, that's because traders are buying bars and they're buying the next bar. So they'll buy the close, they'll buy the high of this bar all the way up. Typically, if you have a buy the close rally and it starts early, before 12:30, 12:35, it's not going to make it to the end of the day. The one exception is if the day's a bull trend day like this. Then you can get a buy the close bull trend starting early in the day and it can last all day. So you can be buying closes early in the day and just wait all day. In general, I'm looking for a breakout, which means consecutive bull bars with decent sized bodies closing near their highs. And then traders will start buying closes, or I personally prefer to buy with stops above the highs of bull bars closing near their highs. And you keep doing it until it stops working, until you get a reversal down, or you do it once and you just hold for a swing up. The market became buy the close with these two bull bars, but it's a strong bull trend. It pulls back to the moving average. You buy above bull bars closing near their highs. So you could buy earlier. You don't have to wait for it to be buy the close. There are other reasons to buy as well. You have a strong bull trend pulling back to the moving average, a bull bar closing near its high. You have a breakout, a bull bar closing near its high, you buy. And then once you get two bull bars, it's also a buy the close bull trend. This final leg up began at 12:05, and typically that is too early for a buy the close bull trend to last until the end of the day, except in one case, and that case is a bull trend day. Bull trend day, buy the close can start very early and make it to the end of the day. Any other day, if you have a buy the close rally starting at 12 o'clock, it's going to reverse. The odds are high that it's not going to make it to the end of the day. Here we have a buy the close bull trend. Bulls will start buying after they see two or three bull bars closing on their highs. However, this is important. This bar, while it's not huge, it's the biggest bull bar in a buy the close bull trend, and it's the sixth bull bar. If you get a big bull bar on the fifth or sixth bar of a buy the close rally, it's probably going to attract profit taking. And if anything, you're going to be selling that close to take profits. Or if you're an aggressive bear, you'll sell betting on a reversal down, or at least enough profit taking to make money. So buy the close bull trend, yes, but if the fifth or sixth bar is a bigger bar closing on its high, it's going to attract profit taking, and do not take that buy. I typically would exit my longs on the close of that bar, but if I do not, I'll get out below the low of a bear bar, especially a bear bar closing on or near its low. Bears will take that short, betting that the bulls will take profits at the end of the day, and you can get a pretty sharp move down. All of these buy the close bulls, if it were earlier in the day, they could hold through a pullback, expecting the market to continue up. But late in the day, there's not enough time. So if it starts to sell off, all of these bulls will sell. They'll exit, and you can get a panic move down, and therefore bears will take that short. Normally, you don't want to short when a bull trend is this strong. That's maybe a 10-bar bull microchannel, no pullbacks in 10 bars, 6 consecutive bull bars. But this is a special situation. End of the day bull trend, bear bar closing on its low, and the biggest bull bar being the sixth bar in a buy the close market. That combination is going to attract profit taking, and bears will sell. Very good rally. Lots of bull bars closing on or near their highs, so it's a buy the close bull trend. But look to the left. It's not in a strong bull trend day, it's in a trading range day. If a buy the close bull trend starts before 12:30 and it's a trading range day, the odds of making it to the close are small. The odds are like 70% that you're going to get a reversal before the end of the day. The bulls can argue we have a wedge bottom, and we have a good bull bar here, a good bull bar here. Lots of bull bars closing near their highs, but look to the left, trading range. After 2 or 3 bull bars, you decide it's a buy the close bull trend, and traders will start buying above bull bars closing near their highs. This is dangerous here. It's a bigger bull bar. It's at least 6 bars into a buy the close bull trend, and it will attract profit taking. Bulls will say, wow, I wasn't expecting this much money. I'm going to take some profits, and it can lead to a reversal. $11.15, way too early for a buy the close rally to make it to the end of the day. 70% chance we're going to get at least a reversal down for several bars. First reversal down, you might not take that short, but if you get a second sell signal bar, especially a big one like that closing on its low, you have to get out of longs. I would get out of longs below that bar. And this one, it's a second sell, failed breakout, high of a trading range day. I would short that. So buy the close bull trend, but starting too early, you have to expect a reversal. The opposite of everything that I just said is true for a sell the close bear trend in the final hour. We got a bear trend day. A pair of decent bear bars. The market is changing character, tails on the bottoms of these bars, and now closing near the low, bigger bar closing near the low. It's a sell the close bear trend. You can sell below bear bars closing near the low, all the way down to the end of the day. We have a disappointment bar here. A lot of the bears will get out around break even, and that's why the market went quiet. You can scalp repeatedly, or you can simply enter once and hold until it no longer is a sell the close bear trend. There are other reasons to sell as well. We have a bear trend and two legs up, one pullback two, and a second sell signal, 1, 2 with a decent sell signal bar. A lot of bears will short below that. Here we have a pullback from this first sell. They'll sell below that. So in addition to a sell the close bear trend, it's also a low two bear flag, two legs up, one pullback two. If you're just talking about sell the close, here is where it became sell the close. However, there were other reasons to sell before then. Okay, is this a big bear trend day? No, it's a trading range day. Here we're getting a sell the close bear trend. We have a pair of bear bars breaking below that low. But look what time it started, 12:05. If a sell the close bear trend begins before 12:30 or 12:35 and the day is not a strong bear trend day, 70% chance the sell-off is not going to make it to the end of the day. We'll get some kind of reversal up. Here we have a double bottom. We went down and up again, and we have a bull bar closing near its high. I would buy this. I would get out of shorts either 4 or 5 ticks above that. I definitely would get out of shorts above a bull bar closing near its high, especially when it's a second reversal up, a double bottom. We have a failed breakout below this buy climax low. We're in the middle of a trading range day. I'm going to get long. I'm going to buy above that bar. Now we have a big outside up bar. There's still time left to the day. That is an okay buy. We might go up a little bit more. I would rather be buying here than there, top of a trading range day. Magnets, support and resistance. Support and resistance draws the market to it. So every support and resistance level is a magnet, and magnets are important, especially at the end of the day. We sold off, we rallied, we sold off. We're rallying, but it's not all that strong. Whenever the day has a lot of trading range price action, you always have to be thinking that the market may try to test the open at the end of the day. Here's the open of the day. What do we have here? We sold off, we rallied exactly to a measured move up based upon the open. That tells you that the open is important. The low of the day obviously is important. If we go up exactly for a measured move based upon the open, that tells you the market's paying attention to the open. And therefore, late in the day, you have to wonder if the market may come back and test that open again. We have a wedge rally, 1, 2, 3. So a spike in channel pattern, breakout, spike, pullback, and then 1, 2, 3 pushes up. Possible candidate for a reversal back down to the open. I'm not going to sell below a bull bar, but we have a wedge rally, and now we have a second sell. A doji is not a great sell signal bar either. However, if you get bear bars closing below their midpoints or on their lows, that is a reasonable sell, looking for the market to get drawn down to the magnet, the open of the day. Here we have a trading range day, and here's the open. Look how many times the market tested the open. So clearly, the open of the day is important, and therefore, if it's important, it'll also be important at the end of the day. You got to be thinking that the market may try to come down to the open and close near the open and create a neutral bar, a doji bar on the daily chart. So if you're above the open, you look for a reversal down. If you're below the open in a trading range, you look for a reversal up to the open. We have a potential small final flag here. We have a reversal down and then a second bar, a bear inside bar. The first sell would be below this bull outside bar. Not good. Better to sell below a bear bar closing near its low, and that would be a sell, looking for a test down to the open. If we get down there, we could stay there and close in the middle. We could go down to a new low, or sometimes we'll test the open and reverse up and close on the high of the day. In any case, this is the sell. You got a second sell signal. Here's the first, here's the second, a good sell signal bar, and room to the open. The market got near the open, but did this. Had you taken that short and you did not scalp, you'd get out above this bull bar. And if you understand what's going on, that this sell-off was a test of the open, you would buy above that bull bar. It's also a double bottom with this low, or you'd wait for 2 or 3 bull bars. And then you would start buying above the high of the prior bar if the bar closes near its high. We ended up with a buy the close rally, and the day closed on its high. Open near the low. We tested the open repeatedly here. We tried to get down there here, but we got a good reversal bar here, a double bottom, and now we're starting to get a series of bull bars. Traders will buy above these bull bars, betting that the day is going to close on the high. Here's the open of the day, trading range day. You can see the market is testing the open. Trading range day, we tested the open, we tested the low. There are a couple ways to play this. If the average range is about 10 points, 15 points, and you're about 4 points below the open, you might place a limit order to buy 4 points below the open and a stop 4 points below that, betting that the probability is we'll get up to the open and you'll make 4 points instead of losing 4 points. Alternatively, you can buy with a stop above a strong bull bar here or here and then take profits near the open. And you can see a lot of traders sold at the open. Some of the selling that took place here is from bears with limit orders at the open, looking for a reversal down, either for a scalp or a swing. And some of it is from bulls who bought here or here, taking profits. A decent stop order buy. We have a bear channel, a bull breakout, and a pullback. If you want, you can call it a higher low double bottom or higher low major trend reversal. 2 legs down, 1, pause, 2. A good buy setup, especially after an earlier decent buy setup. Had you bought 4 points down, you could get out at the open with 4 points. Had you bought with a stop up here, you could get out with, in this case, about 3 points. Sometimes it'll get to within a couple ticks of the open and reverse down. If that happens, you get out on the reversal down. For example, if these highs did not quite reach the open and these bars look like this, you would get out below these bear bars. Trading range day, sometimes you get pretty sharp sell-off, yet the market still tries to come back to the open. Trading range day, we're above the open, you look for a reversal down. We're below the open, look for a reversal up after 11 o'clock late in the day. You can call this a higher high major trend reversal. You can see moving average. So we gapped up and rallied sideways, broke to the upside, reversed down. It's a second sell. Here's the first below this bar. Here you get a bear bar closing on its low, a reasonable sell. At a minimum, you're looking for a test of the open. Another bear bar closing below its midpoint, bear bar closing on its low, and room for a scalp. If you sell below that bear bar, you get filled right here. Room for a scalp, so you can still take that trade. And then we're breaking below the open. This is really not a great bet. You have a bear flag, and you're taking a chance that you're going to collapse. We could just as easily have formed a small double bottom and reversed up. Sell the closed bear trend, and this is at least 5 or 6 bars into the trend, and what do you have? You have the biggest bar in a sell the closed bear trend in a trading range day. That will attract profit taking from the bears. Bears will buy back their shorts, and bulls will start looking to buy. Aggressive bulls will buy that close. Other bulls will buy above this bull bar, looking for a test back up to the open. And the day closed almost exactly at the open. On the daily chart, this would be a doji bar, a neutral day. How to exit? If you're in a buy the close rally at the end of the day, final hour, and you get a bear bar, especially a bear bar closing near its low, you get out, because the bulls who have been buying don't want any pullback, and they don't have time to sit through a pullback. The day will be over. They will get out below a bear bar. Bears will sell. So if you get a bear bar closing near its low, you get out. Bears will sell. Another way to exit is if you're in a buy the close rally at the end of the day, especially in a trading range day, you can either exit 1 tick below a bear bar or 4, 5, 6, 7, 8 ticks below a bull bar. If the bull bars are very big, exit 2 points below. If the bull bars are average, exit 1 point below. And that's because sometimes the reversal down will be so big that if you're waiting for a bear bar, you may get a huge bear bar following a bull bar, and you'll end up selling too far below the high. For example, this. If you say, okay, I'm only going to get out below a bear bar, that might be more than you want to give back. So if you bought anywhere here, here, you'd be getting out with a loss or break even. So as an alternative to getting out below a bear bar, you can get out 4 or 5 or 6 ticks below a bull bar. So as it's going up, if I bought for any reason above any bull bar, I'm going to have a stop to get out maybe 4 ticks, maybe 8 ticks below every bar. Bull bar, doesn't matter. And I will get out 1 tick below a bear bar. So if I did not get out below here, if I did not get out 4 ticks below there, I definitely would get out below a bear bar. If you're trading by the close, always have a stop to exit somewhere between 4 and 8 ticks below the low of the prior bar. If the prior bar is a bear bar, you get out 1 tick below. Risk happens fast at the end of the day. Here we have a sell the close bear trend. You can get out above a bull bar. Alternatively, you should always have a stop to exit somewhere between 4 and 8 ticks above any bar, including a bear bar, because you can get very abrupt reversals at the end of the day. Sell the close bear trend, testing the open. But remember, when it tests the open, it could keep going down, it could stay sideways, or it could reverse back up to the high of the day. If you take that short, I would get out 1 tick above a bull bar. Or if this bull bar was huge, I would be getting out maybe 4 ticks above the prior bar, bear bar. Bulls will buy this. they'll view this as a sell vacuum test of the open of the day, and they have a decent bull bar, they'll buy that, and they'll buy above this, looking for a rally into the close. I began by talking about smart money, how institutions trade heavily in the final hour, trying to position themselves for what will take place tomorrow. And because there's so much volume, you can get very big moves and lots of trading opportunities. If the market's in a very tight trading range after 1245, it's a limit order market. Traders should be entering with stops most of the time, certainly at the end of the day. And therefore, if it's in a tight trading range, you stop trading, you wait for tomorrow. Buy the close bull trend. If the market has two or more decent sized bull bars closing near their highs, you're probably in a buy the close bull trend at the end of the day. If it starts before 12:30 or 12:35 California time, Pacific time, the trend is probably not going to make it to the close. You have to look for a reversal. Buy the close bull trend. You either buy the close of the bars or you buy on a stop above the high of a bar closing near its high. Sell the close bear trend, just the opposite. It begins with two or more decent size bear bars closing near their lows, and then traders will start to sell with a stop below the low of the bar. Some traders will sell at the market or sell on the close of the bar. At the end of the day, support and resistance are magnets. Traders should look for the market to move toward important magnets. The most important one is the open of the day, especially if the day is a trading range day. If the market is above, you look for a reversal down to the open. If the market is below the open, you look for a reversal up. How to exit at the end of the day? You don't have a lot of time. If you're long and the market is rallying in the final hour, especially the final 30 minutes, you get out one tick below a bear bar. And you also place a stop to get out 4 to 8 ticks below any bar, including a bull bar. If the market's in a bear trend, you get out one tick above a bull bar, or 4 to 8 ticks above a bear bar. I'm Al Brooks. Thank you for watching this bonus video on trading in the final hour.